New Chinese loans plunged by 61% in April, setting China back at a very critical moment. In fact, what it shows is that nothing has changed there, despite the enormous efforts from the government in Beijing. That's really the troubling aspect to all this. Yet more evidence for the slow, grinding death to the Chinese economy. And this is actually the worst case, especially for the rest of the world, that nothing in China will change. And the latest figures show that, yep, absolutely nothing has. New RMB lending came in at an incredibly weak 280 billion, the lowest for any April since 2005. And this comes even after a mountain of so-called stimulus that keeps failing to stimulate anything, banks or the real economy. Without the banking system, China can't do anything else other than to try to manage its own slow death. And believe it or not, that's what Beijing is aiming for. Maybe Xi Jinping has fanciful ideas of a new economy built on sci-fi levels of new technology, a so-called fourth industrial revolution. While that makes great media stories, he's only hoping to keep the political, economic, and financial situation just stable enough to give this long shot a chance to work. And this is where the bank recapitalization plan that was announced last year, and haven't heard much of it since, that's where it's coming from. To keep the lights on just enough at the big policy banks in order to hold it all together and manage this decline. But how did it get to be this way? Why are banks so impaired? I mean, yes, the real estate bubble, that's the easy answer, but the real answer, the bigger picture, far more detailed than that, far more connected. This is a globally synchronized story that is a cautionary tale, not just for China or about China, but for everywhere else around the world. Because as China continues to decline, its slow grinding death in the economy, that's going to have spillover impacts everywhere. As I've been saying over the last couple of years, something big changed in Chinese banks. And without the Chinese banking sector offering its support to the government and its efforts to stabilize everything, the challenge becomes that much greater. So if the upside is continued slow grinding death of the economy, the downside is, at least feared by the Chinese government, something like Japan 1989. But before we get to the big picture, let's talk about what just happened, what was just announced from the People's Bank of China. They published their statistics on credit and lending, the financial statistics report from the PBOC, as well as total social financing. And in the financial statistics report, what they said was the outstanding stock of all local currency loans increased by a 7.2% year-over-year rate in April, which is another new record low. And that's down sharply from the 9.6% year-over-year rate last April, and it was nearly 12% year-over-year in April 2023. Household loans in China during the month of April, they declined by 522 billion, which is almost exactly the same amount of the decline last April, again showing that absolutely nothing has changed. Even though between last April and this April, the Chinese government has gone completely crazy with its quote-unquote stimulus plans. But nothing has changed. They've done rate cuts, there's been targeted support, and it's not working. In terms of total social financing, aggregate financing to the real economy, which is the broadest measure of credit and debt that the Chinese offer, AFRE increased by 1.16 trillion, which was higher than last April, but largely because of the same factors we keep running across, which is the government bond sales. And these government bond sales, the so-called bazooka, is simply the government as the only game in town as the banking sector continues to step back. As far as RMB loans, as I said in the introduction, just 280 billion in new RMB loans in April, down 61% from last April, which was not a good number to begin with. It was well below analysts' expectations of 700 billion, but analysts are always over-optimistic because they buy into the stimulus nonsense. And that 280 billion for April is the lowest of any April going back to 2005. So all the stuff that has happened between last year and this year, and nothing has changed. And that's a big, profound realization. It goes beyond just the short-run period. It goes beyond trade wars. This is not even, trade wars aren't even in the same area code here. This is a big picture story that is playing out in China, unfolding over a pretty long time scale. And it has to do with everyone else outside of China as well as inside of China. For the banking sector, the question to ask is, how did it get to be this way? What you have to realize is that Chinese banking sector has been the shock absorber to the system for well over a decade now. The PBOC Now, what it does is it tries to give the big banks resources that they can use and turn around and support the rest of the banking sector, as well as the real economy. The whole world, by the way, works this way. The Fed, the ECB, they do the same thing. They attempt to support, they tell everybody they're supporting the banking sector and the banking system, which does all the dirty work on behalf of the central bank. And that's one reason why it doesn't work, because if the banks are malfunctioning, then central bank support and influence over the banking sector really doesn't help at all. And that's where China has run into bigger and bigger problems here in the 2020s. The Chinese are just more explicit in the arrangement, where the PBOC is an auxiliary support for Chinese banks. They actually carry out all the shock absorber business. And in the 2020s, they have been asked and directed to support a whole bunch of various government objectives. And one of those is the currency. As CNY continues to get weak in any short-run period where it is weak, what we'll see is a flood of reports coming in saying that the big Chinese banks were borrowing dollars in FX markets in order to sell them in offshore currency markets, trying to support CNY. So already, just in terms of the currency weakness, you see the government asked the big banks to carry out its policies for it. But the big one, though, that's real estate support. There have been various ways in which the Chinese government has asked and even demanded the banking system support the property sector. But more, just recently, last January, the government created a whitelist of projects that were supposed to have been checked out by officials at the local level and therefore approved. And then with much fanfare, the government said that the banking sector would support this whitelist of of real estate projects, providing funds to make sure that the real estate sector would stabilize and help the economy grow from there. As CNBC reported last January, China's financial institutions should provide strong support to the country's beleaguered real estate sector and not, quote, blindly withdraw financing for projects facing difficulties, at least according to a senior Chinese financial regulatory official. Quoting him, "The financial industry has an unshirkable responsibility and must provide strong support," at least according to the deputy director of China's National Financial Regulatory Administration, which that's the translation that CNBC put together. But even by May last year, several months into what was supposed to be a massive support effort, it wasn't going all that well. As Reuters reported, just a couple months after all the fanfare and all the press conferences, all the celebratory language and media stories, what Reuters reported in May 2024 was, when China's local governments began compiling a whitelist of housing projects for loans earlier this year, troubled developers hoped it would open a spigot of credit for a sector that remains a major stumbling block to a broad economic revival. 4 months later, new funding is only coming by the drip, reflecting the deep-seated caution about the outlook for China's residential property market, at least according to Reuters interviews with bankers and developers. So straight away, the banking sector said, thanks, but no thanks, we really would rather not. Fast forward a year, and there's a report in the People's Daily this January that says, despite their reluctance and probably a lot of convincing on the part of government authorities, Chinese banks have been lending to these whitelisted projects. What it said was, at the end of last year, that's 2024, the loan amount of commercial banks' real estate whitelist projects was 5.03 trillion yuan, exceeding the original expected target of 4 trillion. As of January 22nd this year, the loan amount has increased by another 570 billion yuan, and the loan amount of real estate whitelist projects has now reached 5.6 trillion. So what that says is that they were reluctant before all of the stimulus measures, and now that they're lending to these whitelisted projects, as in essence bailing out all of these troubled developers, what they're doing is they're doing that because Beijing has told them they really have to, but at the same time, they're pulling back credit and balance sheet capacity to everywhere else. This was not how it was supposed to go. The banks were supposed to help support the real estate sector, as well as to continue to support the real economy in the regular activities. And the banking sector said, you're just asking us to do too much. Okay, you want us to bail out the property sector and support all of these real estate developers? That's what we'll do, but it's going to come at the expense of everything else. In other words, China's banks are supposed to be a shock absorber for all of this stuff. And what they're saying is, we just can't do it to the degree that everybody wants us to any longer. And this includes, by the way, support to something called local government financing vehicles, or LGFVs, which I'll get to in just a second. Since most local governments in China get their revenue from property sales, the stagnant to contracting real estate market means that these local governments have been in enormous trouble for quite some time. Among other things, they can't pay back all of these loans and these bonds that have been issued. And so the government wants the banking sector, the big banks in China, to help, quote unquote, support local government financing vehicles as well. On top of supporting the real estate sector, on top of financing local government financing vehicles, on top of everything else, bailing out the currency when called to do so. They also have to provide liquidity into wholesale markets to keep everything liquefied. It's just way too much to ask the Chinese banking system that is already reeling from way too many problems. So the bank recapitalization plan is meant to try to revitalize and add a little bit more capacity to the big banks so that they can carry out the duties of what are really supposed to be, or really what's supposed to be done by central banks. The banking sector is the engine of credit and money and everything else in the economy. The central bank is simply there to try to support it. But if the banking sector is experiencing all these difficulties or just has too much on its plate, it's not going to work out the way everyone intends. So naturally, the question to ask is, where did all of this come from? Where did this start? China used to be this economic miracle that everybody pointed at and say, wow, I want to be like the Chinese. For good reason. The country absolutely transformed itself from rural agrarian subsistence agriculture to an economic industrial powerhouse. It certainly wasn't perfect, but it was an economic miracle. What happened to all that? And the short answer is 2008 and the Silent Depression. The slightly longer answer to Beijing's response to all this is fears over becoming Japan 1989 and 1990. The Chinese government is deathly afraid of repeating Japan's banking crisis and then its lost decade in the 1990s, not realizing they don't need a bank crash to get a lost decade or maybe 2 decades anyway. That's this long, slow, grinding death in the Chinese economy they've already been experiencing this entire time. And it goes back to 2008, the real estate problem, everything. It goes back to the 2008 crisis. What people may not remember is that the Chinese were the first major government to respond to the 2008 crisis. In November 2008, it was China, it was Beijing, it was who came out onto the world stage and said, yeah, we're going to do big Keynesian stimulus. On November 10th of 2008, Beijing announced a massive stimulus package of roughly $586 billion, that's the US dollar equivalent, which was a mammoth 7% of GDP spread out over the first couple years. It was absolutely everything that Keynesians wanted. It was a watershed moment. In fact, the State Council statement at the time said, over the past 2 months, the global, they call it financial, it wasn't financial. The global financial crisis has been intensifying daily. In expanding investment, we must be fast and heavy-handed. Basically, everything that economists ever wanted, the Chinese did it in November 2008. Big numbers, lots of borrowing, stimulus. But the stimulus was only intended to be, as it always is, a temporary measure to get through the downturn until the organic recovery, in this case, global recovery, took hold. Just to fill in the troughs a little bit so that China doesn't experience more of a contraction or downside than is really necessary. As Hu Jintao, who was the president of China at the time, said on November 15th of 2008 at an international summit at the White House, the international financial crisis has spread from parts of the world to the entire globe thanks to the Eurodollar shortage. From the developed countries to the emerging markets and from the financial sector to the real economy, which has exerted a big impact on the economic development and people's life worldwide. And so that justified, in their mind, the Chinese mind, the level of commitment from Beijing on the fiscal side. They also had the PBOC do a bunch of stuff as well. But basically, it was supposed to be a massive spending package to support the Chinese economy and thereby have all sorts of ancillary positive spillovers to the rest of the world too. But what that really meant was the start of China's real estate bubble. And the reason it flowed through local government financing vehicles goes back to a 1994 budget law, which prohibited local and provincial governments from borrowing. So to circumvent that restriction, the central government in China touted the use of these off-balance sheet mechanisms, because what could go wrong with off-balance sheet mechanisms, called local government financing vehicles. Now, they're quasi-corporations that are technically owned by municipalities, but they're deemed to be separate enough that it doesn't run afoul of the 94 law. And so what these LGFVs were supposed to do was to start all of these infrastructure projects that would then combine with developers building real estate and other sorts, industrial properties, as well as developing commercial and retail parks and all those other things. So the local governments would borrow funds, start building stuff like roads and sewers and all the infrastructure. Then along would come the developers, and this massive building boom would fill in the gaps left behind by the 2008 crisis and the Great Recession. But like I said, it was only supposed to have been temporary, just enough for the world to get back on its feet. But what happens if the world doesn't get back on its feet? Well, the Chinese, they continue to go ahead with their Keynesian stimulus. There's another big package in 2012, yet the economy grinded slower and slower and slower no matter what, because the global economy never recovered from 2008. This was all, China included, depression economics. And China kept it going since they realized they had little other choice. They did have another choice, which is where Xi Jinping comes in, but they believed in the early 2010s, they had little other choice. In one part because they believed all the rhetoric from central bankers and economists who told them just give it enough time, QEs are going to work, the economy's going to come roaring back at some point, just hang in there, build all these ghost cities, and we'll see everything come back at some point in the near future. But that's the thing, it never did. Silent depression through the entire 2010s. And Xi Jinping, more than maybe any other government official around the world, realized this. He gave Li Keqiang, his number 2 at the time, one more chance to prove this Keynesian stimulus stuff in 2016 at the bottom of what we call Eurodollar number 3. But very quickly he saw that at best, all that final massive stimulus push, all it did was create more debt, create more unnecessary real estate imbalances, and it only led to a small amount of reflationary growth in China as well as the rest of the world, called globally synchronized growth. But it wasn't nearly enough. So China kept racking up more and more debt, more and more of a real estate bubble with none of the growth to support it. And so when it didn't work, Xi Jinping in 2017 pulled the plug. This was the 19th Party Congress. In October of 2017, it called for the rejuvenation of China's economy, which basically was a euphemism to the old way under Deng Xiaoping that would transform China from the early 1990s. That no longer works because the global economy isn't the same as it used to be. The Depression killed China's economic model that had been using for decades. And this is when Xi Jinping became dictator and China began its reform agenda. But then in the 2020s, I think this is where Xi Jinping really miscalculated. Initially, in 2021 in particular, China saw a rush of activity related to lockdowns and everything else. Everyone said that this was going to be permanent. I mean, that's what all the economists said. Warren Buffett called the red-hot economy and recovery. It was going to be a permanent plateau of prosperity. So Xi Jinping pounced on that. He issued his red lines for developers intending to accelerate the reform in the real estate problem, to use this economic resurgence and renaissance that he saw in China as the final means to clean up from this decade-long bubble in real estate left over from 2008. But in doing so, first of all, targeting real estate, it undermined almost everything, right down to the local government financing vehicles and their local governments who depended upon those real estate sales and property sales for the bulk of their revenue. So local governments were no longer getting funds. At the same time, they couldn't pay back all the loans that they've been taking to support and maintain the property bubble to begin with. And of course, as that took place, banks all over China were impacted because they were stuffed with all these bad loans that local governments couldn't pay. At the same time, developers, same thing. Developers no longer had any sales. They had all of these debts. All the debt, none of the economic growth, and now suddenly none of the real estate bubble. It was a massive miscalculation on Xi's part, especially since China's economy it wasn't a recovery, it wasn't a renaissance. It was only a temporary reflation. It was an illusion, mostly the price illusion. And what little direct impact China did get from that period, it didn't last anyway. And of course, zero COVID and those policies didn't help. So by the time that China reopened in 2023, the damage had already been done. And they've been living with the aftermath and the consequences ever since, including now the fact that the banking system is no longer able to be a shock absorber in every different capacity because there's too many things going wrong at the same time. So what if China's worst case is not a crash, but that nothing changes. It's been that way since 2017, with some shifts and some differences in the 2020s, but overall, basically the same. Beijing had been operating on an economic model which just doesn't fit the world that developed after 2008, the silent depression. They gave it a try in 2008. They did the Keynesian textbook to a T, but like I said, all they got was the debt and none of the growth. As this slow, grinding economic death continues, China will be a drag on the entire global economy. It will be a source of friction, a source of volatility in the financial system and maybe beyond. China will be the perfect example of depression economics here in the 2020s. We didn't leave them all behind in the 2010s. If anything, they continue on into the foreseeable future, which means nothing much has changed. Sadly, that view goes for the U.S. labor market as well. As we saw yesterday, layoffs with Microsoft and more data on the labor market, and went over all of that in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.